Hello, everybody. Today, our special guest is Steve Flynn from Andersen. A little bit about Steve Flynn. Steve focuses on cross-border tax matters, including investments between Canada and the U.S. by both individual businesses and U.S. citizens residing in Canada. Steve has spent his entire career providing professional services both in public and private practice. A little bit about Steve. He is actually, his experience in the areas that he works in is Canadian investments in U.S. businesses and real estate, cross-border strategies, U.S. citizens residing in Canada, U.S. businesses expansion into Canada. And without further ado, I wanted to introduce Steve, and we look forward to covering today one of the very, very hot topics out there in the marketplace right now is when a U.S. person moves to Canada, they have their Roth IRAs, and there is an election that has to be filed. So we'll get into that in a few moments, but I want to make sure that everybody gets to know who Steve is. We work very closely with him. And Steve, welcome to the show.
Gerry, great to be a guest on the inaugural podcast. I'm looking forward to it this morning.
Yeah, we were hoping you were saying that this was the 1000th podcast, and eventually we had time to provide, to get you involved as well. But
I look forward to being a guest on the 1000th anniversary episode.
Well, it sounds like we've been picked up for 20 years, so it sounds like you will be on the show a few times. So, but anyhow, just the big thing that we want to do when we introduce people to the audience out there, the people that have downloaded the Snowbird US Day Tracker or the Canada Physical Presence Tracker, big audience that participates in these podcasts. We really like to get to know more about our professional guests. So I know you're a good Saskatchewan boy. So tell me more about your life and how did you end up in Vancouver and the educational journey along the way?
Sure, happy to do it. I was born and raised in Saskatchewan. I grew up in Regina. I ended up doing my university at the University of Saskatchewan in Saskatoon. So I got to live in both cities for a number of years. I and about a dozen graduates from the University of Saskatchewan went out to Vancouver with various positions in accounting firms and marketing companies and sales companies, really thinking I was only going to live on the West Coast a couple of years and then move back east, like a lot of people do. Fell in love with Vancouver, met my wife out here, and I've stayed ever since. And so I'm at that point in my life where I've spent more time in Vancouver than I have in Saskatchewan. Saskatchewan still kind of feels like a home in some respects. It was a great place to grow up. I get back once in a while to see friends and family. But it's been a long time since I've been here, certainly.
Now, I always have to ask people is that tax is such a complicated, I don't want to say it's boring because there's an importance behind accounting and tax and in both countries, but how did you choose tax?
It's funny in university. So my father was a tax partner at Clarkson Gordon in Regina. Clarkson Gordon, the name's not there anymore, but that was the precursor, the predecessor firm to Ernst & Young in Canada. And I got to watch kind of what he did as a career. And interestingly enough, I would have said as a kid, that's probably the last thing I wanted to do. I ended up going to College of Commerce, to business school, which now is the Edwards School of Business in Saskatoon. I pursued a lot of different areas and just kind of fell back into accounting and saying, well, it's a good fundamental, it's a good background. Did accounting and was always interested in tax in the sense that it was easy to create value for what you're doing. It was kind of an area that was challenging, certainly, and one that I pursued at Ernst & Young quite a bit on the Canadian side, but then got involved with U.S. tax as well when I came out to Vancouver.
Now, as tough as tax is, we now have people like yourself, which are very valuable, a cross-border accountant. Tell me a little bit more about that cross-border accountant and exactly what do you do and how do you get those tax returns to kind of figure out it? Because I know the filing date is April the 15th in the United States and in Canada, April the 30th. So how do you get those two tax returns jiving with foreign tax credits, et cetera?
Well, it is a niche market when you think about not only knowing Canadian tax, which is difficult enough, but then understanding all of these U.S. federal implications and federal state tax law. And then, if that isn't enough, there's 50 states and each state has different rules, whether they're business tax or individual or sales tax or everything else in the U.S. So you've got hundreds of jurisdictions. One of the things in a niche area is you need to commit to saying, okay, well, I'm going to learn these two areas of the law. I will let other really smart people deal with all the other areas of accounting and business that are important, whether it's audits or preparing financial statements or business consulting. Andersen, we don't focus on any of that. Those are real tough areas as well, and we let other smart people deal with that. We just solely focus on US and Canadian individual and corporate tax. And, by being disciplined and keeping that focus, we're able to keep up as well as we can. I think the other important thing is to, even within those disciplines, figure out what your focus is and then make sure you got a team around you that can help you. For example, for my clients, I tend to focus on what's called the high net worth area. So these are individual families. Generally, they could be US citizens resident in Canada. They'll have complex, situations. They'll have a family business. They'll have their own personal trusts. They'll have investment portfolios. They'll have things that make it, challenging. And I have a lot of other colleagues within Andersen that can handle the business side, that can handle sales tax, that can handle state and local tax across the US. And so it's really important to have a good team around you.
When you and I were sitting down we had lunch a couple of weeks ago, and I was telling you we're going to do this podcast because we know this is a space that's growing. And even with us building the apps, both the Canada Physical Presence Tracker and the Snowbird app, that there's so much activity going back and forth. And even long before this pandemic, we saw the amount of Americans that were coming up to Canada, a lot of Canadians that were coming home. One of the subjects that, there was a great blog written by a couple of my colleagues, and we found this one very, very interesting because everything you discuss when it comes to cross-border issues, it's lengthy. So the one that we're discussing today is the American moving up to Canada with their Roth IRA and the election that they have to file by April 15th, if I'm correct. The previous year they move up here.
We'll talk a bit. Yeah, we'll talk about some of the deadlines on how you file that in Canada, what you have to do, and I think it's important to step back and say, well, what is a Roth IRA? Because it's a very unique term, and it's something that you often see U.S. residents, U.S. citizens who've lived in the U.S. for some time, who are building an investment portfolio. They're building assets towards their retirement. And one of the avenues you can do in the U.S. is you can put after-tax money aside in an account called a Roth IRA that won't, like other pension funds, like a traditional 401k in the U.S. or an individual retirement account in the U.S. or even the Canadian equivalent of a registered retirement savings plan or a registered pension plan. Those plans are all pre-tax money. This is an after-tax savings account that, when set up properly, the investment income from the account, interest, dividends, capital gains, none of that is subject to U.S. federal tax. None of it's subject to state income tax if you live in a state that's taxable. And you can let it grow tax-free. And when you turn a certain age, and in the US right now it's 59 and a half, now you can start to take funds out of that plan, again, tax-free. So a very, important plan for people to save for retirement.
Now, and once again, all those vehicles that these Americans are setting up in United States, and all of a sudden they're great, but now they decide they want to move to Canada.
Right. And that's where the differences come in. And that's where a firm like ours often helps, because now you've got two countries trying to determine, well, what's the taxation here? The US has already set those rules as I've described. Canada, in general terms, would say, well, unless you meet certain requirements, this is a taxable account in Canada. We're going to tax the interest. We're going to tax the dividends as they arise. However, under the Canada-US Income Tax Treaty, and this has been in effect for a number of years, a U.S. citizen or a U.S. resident who moves to Canada, who has a Roth IRA, can come to Canada, and in that first year, when they file their first Canadian tax return as a resident of Canada, they make an election. They put a bunch of prescribed information on a free-flowing form to Canada Revenue that says, I own a Roth IRA. Here's the balance, here's the account. Here's my commitment to you, Canada Revenue, that I have not contributed any funds to this Roth IRA since I moved here. and I won't do so. And when you make that election in that first year with your return, then what'll happen is Canada will treat the Roth IRA the same way as the US does, which means any interest, any dividends, capital gains, they're also tax-free for Canadian tax purposes. As long as you don't ever contribute any future funds to the Roth IRA, you can still have the same treatment. And then when you turn 60 and you take funds out of the Roth IRA, they're also not subject to Canadian tax.
Now, how many people, when we hear deadlines and people move up to Canada and they say it's got to be April 15th of the year after you move to Canada, how many poor folks out there, Americans living in Canada, are running around with the fear that they did not file this election, and what can they do?
Sure. And to be clear, this is an election you file with the Canadian government, with your Canadian tax return. So that due date in general would be April 30th of the year following the year you move to Canada, and goes with your tax return. That deadline could be as late as June 15th. If you're self-employed in Canada, Canada gives you an extra 6 weeks to file your tax return, which would include that Roth IRA election. We often see individuals who just haven't made the election, didn't know about it, weren't sure about it, didn't think that was an issue. What they're able to do, again, so long as they haven't contributed to the Roth IRA plan since they moved to Canada, they can make a late Roth IRA election. There's a process you go through, and the competent authority with Canada Revenue has stated that, there's a certain address in it too, there's certain information you provide. As long as you haven't contributed, you can make that late election. And for all the years since you moved to Canada, the income, the dividends, the capital gains are still tax-free for Canadian tax purposes. The key there is you can't even contribute $1 to the Roth IRA, because once you do that, then the entire account becomes taxable in Canada.
So if an American moves up to Canada here and then decides to go back to United States, there isn't any issues then, is there? If they've continued to contribute and then they're back into the United States where they're going to retire, is there any issues that way?
Well, that's correct, because the account is considered a pension under the Canada-U.S. Income Tax Treaty. When one leaves Canada, it wouldn't be subject to any of our Canadian departure tax rules. The funds are not subject to Canadian tax when you leave. You can keep the same status by being in Canada 5 or 10 or 15 years and going back. And that's the importance of making that election, but also the importance of keeping the Roth IRA as it is, as opposed to cashing it out or doing something else.
As we go through this process here, so where does a client get notification they've moved to Canada? Because we know, I've had this discussion that as soon as an American moves to Canada, they have problems with their existing brokerage firms because they don't have the exemption to manage these IRAs for Americans living in Canada. So who would notify them of this rule? Is it a Canadian? I mean, I think that's the importance of this podcast and spreading the word and informing people. But outside of you and I, how do people find out about it?
Well, and I think that's a tough. There isn't any letter, there isn't any form, there isn't any notification that's going to say you need to do this. That's the importance of working with a tax firm that has experience in Canadian-U.S. cross-border taxation. It's also the importance of working with an investment firm, like a Raymond James, that can take the ownership of these accounts, or take the management of these accounts, pardon me, and say, we don't have to change the structure. We can treat it as a Roth IRA, the same rules and the same conditions, and manage it from Canada. And that way we're not having to cash it in or do anything we wouldn't want to do. The problem, particularly when people are under the age of 59 and a half, when they cash in or collapse or withdraw funds from the Roth IRA before that date, there's a 10% early withdrawal penalty. And so, we just wouldn't want to see clients have to experience that when there are better solutions, which again is a firm like yours, Gerry, to hold the account, to manage the account.
A couple other things. We talked about some case studies that you wanted to bring up, or changing names to protect the innocent. But some of the things that you were working on that you wanted to bring to today's podcast.
Well, one of the things you often see with individual retirement accounts, and that's different from a Roth IRA, and I want to distinguish the two. A traditional IRA, a pre-tax pension fund, where the individual, when they take money out of the fund, the money they take out will be taxable, both the capital they contributed and the income, the dividends, the capital gains. Because the idea is that you got a deduction, or you didn't pay tax on the money that went into the IRA, but now when you take money out, it's taxable. And often what people will do is they'll look at their planning and they'll look at kind of where everything is, and they'll say, okay, well, I've got this money in an IRA, a traditional IRA. I know I'm going to pay tax on it when I take the money out. If I pass away before I take all of it out, my beneficiaries, whoever's designated as such, they'll pay tax on the income as well. So do I want that? Is that the right decision? Instead, if I decided to say, well, what if I just transferred the IRA, that traditional IRA, to my Roth IRA? Granted, that's going to be taxable now. But what you may find then is if it's taxable now and you're willing to pay the tax now, and perhaps you got low tax rates, or perhaps you've got a situation where you've got a year you don't have any income and it makes sense, or you're looking down the road at different scenarios, it might make sense to pay the tax now versus later. One of the scenarios we ran into was a situation where, the individual was resident of the US, they weren't resident of Canada, but their children were resident of Canada. And all three children were resident of Canada, and all three children were beneficiaries of the IRA. And it happened that all three children were all working, and all three children were at the top marginal tax rate in Canada. And so the individual looked at the scenario and realized that if they passed away with a significant amount of money in the traditional IRA, that when they passed away and the three Canadian resident children inherited those funds, the three Canadian children, when they took money out of the IRA down the road, they could be subject to both US tax and Canadian tax because they're residents of Canada. And the Canadian tax could be much higher than the US tax now. So we helped the individual. The individual did a bit of a model of where their capital was, where their growth expected to be, their life expectancy, and everything else. And I think their decision was, I don't want my Canadian resident children inheriting funds for a traditional IRA and paying tax at, in British Columbia, that top tax rate is 53.5%. I'd better off I pay the tax now, as I'm still living in the US. They ended up moving to a state that was a zero tax state, which made it even more attractive. But these are some of the things you think about when you think about cross-border situations with IRAs and Roth IRAs.
And so much is built around the treaty, and I think the treaty was written in 2009. Is that when the last time it was visited?
Well, yeah, the last tax treaty. So what happens between the two governments is every 10 or 15 or 20 years, they renegotiate the income tax treaty. And in 2007, they announced some of those changes that were taking effect roughly 2010. So about that time frame, Gerry. And that last protocol, or that last change to the tax treaty, included Roth IRAs, if I recall. So that's when the first recognition was for Roth IRAs to be tax-free in Canada under certain circumstances.
But I remember in 2009, the TFSAs came into effect. So I guess that's the question we get a lot of people asking us is that, when will the TFSAs be included in as part of the treaty? And so I guess my next question is that when do we expect this treaty to get rewritten or updated, or are we talking about 100 years from now, or are we talking
bit of a crystal ball? So to back up a second, I think it's important to recognize a tax-free savings account, a TFSA, it does not have the same treatment under the Canada-US income tax treaty that a Roth IRA has. And a tax-free savings account is somewhat similar to a Roth IRA. You can contribute funds to a tax-free savings account. They're tax-free in Canada. The growth happens tax-free in Canada, so you can have big capital gains, interest, or dividends. Won't be subject to Canadian tax. However, if you're a US citizen and you happen to be resident of Canada and you had a tax-free savings account, the income, the dividends, the capital gains, they're subject to U.S. federal income tax. Tax-free savings accounts came into effect in 2009. It was after the last change in the treaty. So that's why the treaty doesn't recognize those. I would anticipate the next negotiation between the two countries would include that. Both CPA Canada and the American Institute of CPAs, the ICPA, have written letters to Congress and to the IRS requesting some of those types of changes, not just for tax-free savings accounts, but college savings plans, which aren't covered by the treaty. And there's a whole host of small things that families find a lot of importance is when they're trying to save for retirement or save for their children's post-secondary education that aren't covered by the treaty that should be. It'll take some time for the two governments to come together. I don't know the answer to that. I mean, we're overdue for some changes.
Now, so I guess that question that comes up with every time you have someone who has an American who has a TFSA, and we know that we have, there's high profile lawyers in Vancouver that have written tax papers on this. So the bottom line is that should American have a TFSA if he's living in Canada, or shouldn't have it? We're under
I think it can make some sense, and I'll tell you why. I mean, one of the concerns with tax-free savings accounts is it considered a trust under U.S. tax law? Because if it was considered a trust, and if it's considered a non-U.S. trust, could there be some extensive reporting requirements in the U.S. where the U.S. wants this 10 or 12-page form that wants the balance sheet and the income statement and who's the trustee, and if you don't do this, the penalties are significant. Andersen and a lot of firms across North America believe that a tax-free savings account is not a trust under U.S. tax law because the contributor, the beneficiary, and the trustee are really all the same person. They're the account holder. You have to have a formation set up with a bank to hold a tax-free savings account so it could be administered. Some of those formation documents will mention the word trust in them, but it's not really, doesn't meet the definition of a trust under U.S. tax law. And therefore, we don't think all that extensive reporting requirements are required. That said, I still think it can make some sense for a U.S. citizen resident in Canada to have a tax-free savings account. Yes, they're taxable on whatever's in that account, but they're not taxable in Canada. And so if you kind of did a modeled scenario where you had, and I think what's the maximum now you can put in a tax-free savings account if you had lived in Canada since 2009, Gerry?
I think we're getting up well over $90,000. I know the limit has been
sure. So let's say it's $90,000. So if you had
Yeah.
$90,000 in a tax-free savings account and $90,000 in a taxable account, so you got $180,000 total, all of that's taxable in the U.S. because the U.S. doesn't recognize the tax-free nature of tax-free savings accounts, but U.S. tax rates are lower on interest, on dividends, on capital gains. In contrast, if only one half of that income is taxable in Canada, meaning the taxable account, what you'll have is you'll be generating Canadian tax liability on the one half that's in the taxable account. You can use that as a foreign tax credit against the entire amount that's taxable in the U.S. You'll probably be better off. The dollars may not be significant, but it could save you a few $1,000s a year in overall tax, depending on how the credit works. The importance there is having some level of taxation in Canada that you can claim as a foreign tax credit on the U.S. return.
It's interesting that, our focus and our time has been spent on the election of the Roth IRA by April the 30th, the following the year that you moved to Canada. But it sure is amazing how complicated the space is. And then we start talking about TFSAs and, is it a trust? Isn't it a trust? Does PFIC come into play with that TFSA as well? And you can see that the importance of having a cross-border accountant like yourself and Andersen, it's very complex.
Well, and there's another abbreviation in there. You drop in a PFIC or a passive foreign investment company, and we often see this with U.S. citizens who are resident in Canada that may invest in mutual funds that are organized outside the United States. So they could be a mutual fund that's set up in Canada. It could be an exchange traded fund. It could be even something as simple as a money market fund. any of those things are generally going to be caught by these passive foreign investment company rules in the US that can have some adverse tax implications if they're held in taxable accounts. There are solutions to those, and there can be elections and there can be choices you make. You just got to be aware of the type of investment you're making, and to the extent that you're getting involved in these, because you'd hate to have an investment that the returns are all getting eaten up by all the professional costs and potential higher tax liabilities by holding these funds.
Steve, I really appreciate you coming out today and sharing all your wisdom. I do have to make a great point. You guys put on a great presentation webinar last week on the vacancy taxes and how there's no foreign ownership for the next 2 years in Canada. That's something we'll have to discuss on the next podcast. And we'll make sure that if people wanted to get a copy of that webinar, they can reach out to yourself, because it was all tax. It just makes people head spin. It gets them frustrated. I think there was, after you started adding up taxes on a $2 million home, and I think the tax rate almost got up to 8% for a foreign person.
It was a hypothetical example of and I think the example was it's called a U.S. resident, someone who doesn't live in Canada, who isn't a Canadian citizen, that's got a vacation home in downtown Vancouver. And now in 2023, when you add up the federal unused house tax, the provincial speculation and vacancy tax, and then the city of Vancouver empty homes tax, and I may be getting all the words wrong, but it's an 8%, surcharge. And if it's a $5 million property, I mean, you're spending $400,000 a year for a weekend in Cole Harbour. That becomes very, very, very expensive. And you see people taking action now. They're getting tenants, they're selling places. That's just becoming uneconomical for them. So
yeah. Well, I truly appreciate your time, and like I say, we'll have to, the next podcast we do with yourself, we'll have to depress people with all the taxes they have to pay as a non-Canadian resident who owns property in Canada. So truly appreciate your time, and we'll let you get back to the rest of your day. So thank you very much.
Thank you, Gerry. Really enjoyed it. Happy to be on the podcast anytime. Looking forward to the 100th anniversary show.
Yeah, sounds great. Thank you kindly.
You bet. Talk to you later.